Welcome to our strategic market brief. In today's FX and commodities markets, it is so easy to get lost in the day-to-day noise. So today, we're going to cut right through the headlines and look at what's really driving prices. We're talking about money flows, how traders are positioned, and most importantly, the hidden risks just waiting under the surface. Let's dive in.
All right, here's our game plan. First, we'll tackle the big picture story everyone seems to be telling themselves. Then, we're going to follow the money, see what's really happening under the hood. After that, we'll spotlight one of the biggest dangers out there, a crowded trade that could really catch people by surprise. And finally, we'll pull it all together into a clear, strategic brief you can actually use.
So right now, the dominant narrative is all about this Goldilocks economy. You've heard it, right? The idea that growth is not too hot, inflation's not too cold, everything's just right. It sounds perfect for investors. But the question we have to ask is this story a little too good to be true? Let's dig in.
And this Goldilocks story, this baseline scenario, has definitely made investors feel comfortable. It's been great for risk assets. But look, our job as traders and analysts is to be skeptical. We have to constantly question the assumptions that everyone else is taking for granted and hunt for those hidden risks that could completely derail this perfect picture.
Now this chart shows something really fascinating. For the first time in a very long time, we're seeing serious money flowing out of the US and into other parts of the world. And this is a huge deal. It suggests the global economy might not be so reliant on the US anymore. We could be witnessing a major shift in market dynamics right here.
This whole Goldilocks scenario is really like walking a tightrope. On one side, you've got the very real danger that inflation comes roaring back. If that happens, central banks have to stay aggressive, and that's bad for the market. But on the other side, you've got the risk of a hard landing, a real recession, which is obviously also bad for the market. It's an incredibly delicate balance.
So how can we tell if this Goldilocks story is for real, or if it's just a market fantasy? Well, we have to follow the money, seriously. By looking at who's buying and who's selling, we get a much clearer picture of what's actually going on.
This chart here gives us a fantastic weekly snapshot of the market. You can literally see the constant battle between different types of investors. One week, you might have big banks buying up a currency while hedge funds are dumping it. Understanding these flows, this push and pull, can give you a serious edge. So think of the market as an ocean with two kinds of ships. You've got the massive, slow-moving oil tankers. Those are your real money investors, like pension funds. They're in it for the long haul. And then you've got the fast, nimble speedboats. Those are the hedge funds, the leverage players. They're looking for quick speculative profits. These two groups operate on totally different timelines and with different goals, and you have to know who's steering the ship at any given moment.
And what's really wild is that these two groups are playing two completely different games. Hedge funds, for instance, absolutely love carry trades. That's a strategy that profits from interest rate differences between countries. But at the same time, they consistently bet against momentum. They often sell what's hot and buy what's not. This creates some really interesting tensions in the market that, frankly, we can take advantage of.
Okay, let's talk about one of the biggest dangers in any market: crowded trades. When everybody, and I mean everybody, is on the same side of a trade, it basically becomes a ticking time bomb. All it takes is one piece of bad news, one little shock, to send everyone rushing for the exits at the exact same time. And that can lead to a spectacular crash. So, the big question is there a ticking time bomb in the market right now? I think there is. And it's that very popular FX carry trade. It's been a profitable strategy for a long time now, but I'm really starting to worry that it's just become dangerously overcrowded.
And this chart right here is a massive red flag. It shows that real money investors, remember, those big oil tankers, are all piled into the exact same carry trades. When we see positioning this extreme, historically it is often a sign that the party is about to come to a very abrupt end. The risk of a major unwind here is incredibly high.
So what's the blind spot? What's the one unstated assumption that everyone in this crowded trade is making? It's this: they are all betting that the market will stay calm forever, that this low volatility environment will just persist. But what if they're wrong? What if volatility suddenly spikes? If that happens, this trade is going to blow up.
This table really lays it all out. It shows us where the risks and the opportunities are. As you can see, the carry trade is flashing bright red, extremely crowded, especially with real money. But look at other strategies, like momentum or value. They look much cleaner. This tells me that there are still good opportunities out there, as long as you can avoid the most crowded places.
Okay, so if this crowded carry trade does blow up, which currencies are going to get hit the hardest? That is the million-dollar question, isn't it? And it's exactly what we need to figure out next.
This chart here really shows why everyone is so complacent. Volatility in both currencies and stocks is scraping along at historic lows. It feels like the calm before the storm. But we all know from experience that this kind of calm, it never ever lasts forever. Sooner or later, the storm hits.
So, when that storm hits, which currencies are going to be in the direct path? Well, our analysis shows that the Korean won, the Mexican peso, and the Indian rupee are the most vulnerable. These are the currencies that everyone has been buying hand over fist. On the flip side, currencies like the Thai baht, the Malaysian ringgit, and the South African rand could actually do quite well. They've been heavily sold, so they could see a big relief rally in a risk-off scenario.
Okay, we have covered a ton of ground. Now, let's distill all of this down into a simple, actionable strategy that you can use to navigate what is shaping up to be a very tricky market.
So here's the bottom line. First, don't get sucked into the Goldilocks hype. Be a skeptic. Second, know who you're trading against. Real money and leveraged funds are not the same. Third, spot the crowd. The real money carry trade is a major source of risk right now. Fourth, be prepared for volatility. Know your vulnerable currencies like the won, peso, and rupee. And finally, fifth, identify potential outperformers like the baht and the rand for when things get rocky.
So, I'll leave you with this question. The market feels calm, sure, but the data is showing cracks just beneath the surface. Are your positions truly prepared for when the pressure builds? Really think about that.
Thanks for joining us for this brief. For more in-depth analysis and to really sharpen your edge, make sure you follow Amon Capitals. You can find us on Facebook and TikTok, and of course, check out our website at amoncapitals.com. We'll be keeping a very close eye on this as it develops.